So yeah, you find us live at 8 minutes after 2 o'clock. Welcome to the third and final hour of the show. Thank you very much to everybody that has been with us from midnight to where you find us now, continuing to burn this midnight oil together at the crack of dawn. So we're going to talk property in a moment, and I see Vuyelwa Chabalala is on standby. She's joining us this morning as our guest, coming through as a real estate agent, and Vuyelwa will help us make sense of some of the implications of these tariffs on other spaces like the property space. We hear that the implications could be dire here. There's that ripple effect as well that would play itself out. But this morning, we look at this space as well, learn some more about property and how one can find themselves, being an investor or someone that plays in this space. So if you have questions, if you'd like to pick our brain this morning, you're welcome to do so on 0861 987 000. Thereby X, we go by at PowerFM 987 at Katlego Legodi _ There's a lot that is playing itself out, looking at the times that we find ourselves now. Just a moment ago, we're talking to Tobani, and we're just speaking about the tariffs and the implications and South Africa's approach to where we find ourselves. And this morning, we go into the last hour looking at this space as well, the legacy of growth and the future of possibilities where property is concerned. The United States imposing a 30% tariff on all South African imports. The ripple effect are expected to go far beyond trade and manufacturing. So we see economists, right, and property experts warning that the local real estate market could face new challenges as well, ranging from weakened investor confidence to even slower economic growth due to where we find ourselves with these tariffs. So Vuyelwa will tell us all about it and just try help us in terms of how some of those that are within this space can try protect themselves looking at these export developments. You find us live on 0861 987 000, and thereby X we go by at PowerFM 987 at Katlego Legodi _ Vuyelwa, good morning. Welcome to the show.
Morning, Katlego. How are you?
I'm okay. How are you doing, Vuyelwa?
I'm good, thanks.
Yeah, no, thank you very much for giving us your time. Maybe let's just start by getting an understanding of this property space, the real estate space. And for those that don't know how it works, we do have that space and a market around the ecosystem of property. Maybe just give us a sense of this space, what it entails, and how we've been doing as South Africa in terms of its contribution to the economy.
Okay, so the economy and the property estate in South African economy has been boosting our market, our travel, our tourism, and our rand, which is quite a very important infrastructure when it comes to Reserve Bank and how our interest rate fluctuates on and on. So it really plays a huge role in terms of our investors in the side in South Africa. Whether they are international or local investors, it really speaks to our economic growth.
It does also become an investment for those that would find themselves, operating within this space. Hence, we see them obviously just looking at the repo rate and all of these developments and announcements and how they affect them. And I believe that most of them would also be watching these developments around the United States and the tariffs. We hear that alarm bells have already been rung here around warnings that the local real estate market could face new challenges ranging from, a lot of issues that would be linked to the announcement of the 30% tariff. Let's look at this space and how then some of these issues are bound to affect where we find ourselves now.
So tariffs affect South Africa in various ways. Building materials, especially because South Africa, we import a lot, and it will face a higher rate in terms of buying from the developers, because now what they do is the developers do buy on those higher tariffs, and then they pass it on to the buyers. So now it makes the buyer have a more, rate in terms of getting properties where instead of being affordable, now they're facing higher challenges for affordability now. It is driving out people in the entry level for buying property. And so if they buy your cement, your timber, that costs expensive that side, it will drive up the price of building. So the entry level as well of the development phase tends to be now a bit pricier more than usual.
Do we see also maybe investor confidence affected by all of these developments? I know we have a boom in terms of the property space. At some point, we had President Cyril Ramaphosa talking about turning South Africa into a construction site, and this would be the rehabilitation of old buildings, the establishment of new properties or new, markets and the likes in terms of how we see all of these industrial sites playing themselves out. But do we see maybe all of these issues that are playing themselves out now leading to a weaker investor confidence in terms of it affecting also the economic growth?
Not at all. So what I like about the housing market, it has retained its degree of strength, and the volumes of the sales are still surpassing what has been happening after COVID. So if I can check the stats in our company, they have increased, the sales have been increased by 6.5% as opposed to last year, June, when we look at the stats. So we are very optimistic that also this latest interest rate will cut an impact into local housing, investment and all the industrial side. And also looking at Cape Town, there's a lot of growth there that is also stimulating our economy. There's still a lot of buying confidence. South Africa is still growing. A lot is still happening. Yes, the tariffs will take up prices here and there, but the buying potential, it is still very much there. So it continues to retain its degree of buoyancy.
And this really does not matter whether it's the commercial real estate sector, then the residential real estate sector. When you look at the impact of some of these shocks that would play themselves out, do you reckon that those that would find themselves vulnerable would be those that are operating within the commercial space or the residential space, or impact then becomes the same, looking at how the economy is performing?
The impact will stay the same for both residential and commercial, because I think, what was important before they acquired those properties, they had to make sure that they've got stability with their finances and they do not overstretch themselves, because the market goes up and down. It changes. And, people need to leave our, a place where they can play around with the interest going up and the interest going down. So they need to be wary of how far they went in terms of stretching themselves financially. That will play a role with how the tariffs and everything will just try and play in the economic field. So I feel like nothing much is going to change. It's just the matter of the decisions that they took financially. If it wasn't too much debt, if they didn't take on too much property loan that stretches too thin, and something like income drops for people who are in the residential space, and for someone like when the business is too low and the support and the economic is not that stimulated for whatever industry they're in. So I think everybody at this point should know that they should stay within a safe debt income ratio, and typically like under 30% gross income for whatever that they make, and try and regulate that. So such times when they come, they can still be able to stay afloat.
Just a reminder to our listeners at home that you find us speaking property this morning with Vuyelwa Chabalala, who's joining us on the other side, just helping us make sense of some of these developments, especially where the tariffs are concerned. But this morning we're also learning about the property space, how it works, and how you can safeguard yourself as well amid all of these developments. You still find us on 0861 987 000. There on X we go by at Power FM 9 187 at Katlego Legodi _ And I wanted to check in with you, Vuyelwa, as to how we've seen the rate cuts play themselves out. We've had 5 rate cuts of a quarter percentage point, and we've seen even the recent one, a lot of people saying, it's optimistic, in terms of the prime lending rate, just seeing this cut of 0.5 or 25 percentage points. Does that leave homeowners with a little more cash to spare going into the month? Does that come through with a little bit of a relief, or when you look at that announcement, it does become minimal? A lot of people should then brace themselves or call for more, looking at how the economy has been performing over time.
So it is encouraging that the Reserve Bank may have been pivoting towards a more growth-friendly stance. This is helping us to unlock pent-up demands in the housing market. I mean, while obviously 0.25 cut may seem modest, but it does mark a positive step towards restoring the rate environment we saw, because back in 2020, the repo stood around 6.5. And although now we're still well above that, but we're still well away on a good rate. And this is stimulating our economy, and it's bringing in a boosted need. It's bringing in new buyers who want to come in the market and try out being investors, who want to come in the market and lease out properties for businesses, and also the ones in the commercial space. So it really encourages and it stimulates, and it also helps the sellers that would like to be relieved from whatever debt or whatever maybe liability they're finding themselves in. And this is the time where it actually welcomes in new people in the market. There will be always new people in the market, and compared to last year, I mean it is a very good rate that we're heading to. So 10.5 prime lending rate that is currently now, and I mean it really gives us the confidence, and also it gives the new homeowners a boost to just breathe a little and focus on other property rates and stuff like that also come with a property. So it is really a time now for a little bit of break, and we hope for more.
Does this then come through also to affect the property prices on offer now? Do we see this maybe taking those properties and the prices down? If a property was put down for a million, do we see these announcements that come through affect that price? Or it does then speak to those that would be paying out their bonds to say that it gives you a little bit of a relief, because instead of you paying a 9,000 rand, for instance, we'll see it going down a bit?
It does give everybody a relief. It gives everybody that wants to come in the market a relief, and the ones that are already in the market, in the housing market. So, for instance, for someone that took a house for 10,000, for 1 million, I mean, they were paying 10,152, and with this new rate, they're now looking at 9,984. That's like 168 difference. And we look at people who took your 3 million rand bond, they were paid 30,457 when the rate was 10.75, and now they're looking at 29,951, which is a 506 rand reduction. It really does a lot for homeowners at this point.
And let's talk about maybe you paying your bond forward. Does that help you? Does it position you better in terms of, the expectations going into the future? Does it cut down the number of years that you're expected to pay for this bond? Or how does it play itself out in terms of encouraging people to ensure that they safeguard themselves here? Or does it affect your monthly expectations in terms of the premium that you're expected to pay here? Let's talk about the paying forward process and how one can positively navigate this space in a way that they're able to keep up with the economy.
So you pay off when you, let's say, maybe you add in whatever amount, maybe 2,500, maybe 1.5, whichever one that you feel like it is still in your range to stretch. It helps, paying that the money goes straight to the bond, which is the one you borrowed, the capital, and it really lessens the interest. So the less capital you owe, the less interest rate you're charged. So the banks in South Africa charge interest daily on outstanding balance. So by reducing the balance faster, you pay less interest overall. So over the, or maybe let's say 20-year bond, this could save you thousands or even hundreds of thousands of rands while you are saving. With that extra 1,000 rands, extra 1,500 rand, it really stretches and it gives you back more years in terms of paying off, and instead of waiting for just 20 years. It gives you also allowance that should such things happen when there's an interest drop, you go robust on it, and you pay back your time. Say maybe now it goes back up to say 10.75, for instance. You have more, you would have gained more and lessened your interest rate more. So people must just go to the banks and confirm extra payments and see what are they being used to reduce the capital, and just to see how are their bonds and accounts looking like, so they can just go to the bank and speak to their banker.
Yeah, I guess that would help. But let's talk to new entrants in terms of those that would want to go and be players in this space. We always encourage people to more or less be investors, right? Think out of the box and be a player within this economy, because that one salary does not become enough anymore. So what advice would you give then to those that are new players in terms of how they move and navigate this space and stay the test of time without getting burnt? Because there are those that would go into this space and the next thing they're left with so much debt from wanting to just go into this space as an investor. So what would be your advice to them?
So the first advice would be, if you're a first-time home buyer, you can use our government, something that they've created for new buyers, which is called FLIP. You can get an opportunity to get what's the thing, financial assistance from the government. There's also tables where they can tell you from this amount to that amount, they will help you with this much. So it depends on how much you're buying for and how much the bank will help you. And again, they need to know, the new buyers need to know that patience pay off. I mean, many past owners who held on to properties during economic downturns or stagnant market where, we didn't really know where we're going, they eventually saw appreciation in their investment. So they should not be quick to sell off. Timing the market perfectly is less important than the time in the market. So don't time the market. Be conscious of the time we're in the market. So don't say in 2 years' time, this is how much I can make. Just make sure that you look at what is happening in the market at that time. And also location. They should need to look at the location before they buy, and avoid buying based on emotion, based on, this is where I grew up, this is where I went to school. They should buy of location, buy of making sure that it is not an emotional buy, and to also diversify and protect their wealth. They shouldn't just be, because they're investors, they want to come into the space, they want to buy in a certain complex, in a certain town. They need to diversify with some suburbs, to just make sure to check also the municipalities if they're in good condition, if that area doesn't have problem with water issues, light issues, because that also tends to affect the prices in that market, in that area. They do affect if there's water issue and stuff like that. So they need to actually check what is it what works for them, and also look at the maintenance and the upkeep. They really do pay off. Houses that are really kept well in the market, they don't stay that long at all.
And how important is it that you get your credit score right? Because you need to, again, also, position yourself for the possibilities of what lies ahead. Sometimes we hear that you need to get your house in order as well, in terms of just having somewhat of a strong credit score, or not in any way be finding yourself having judgments and the likes. How can they approach these one as well? And does it matter where your credit score stands?
Yes, it does. So credit score shows how well you manage your debt. It is really the first thing we look at before you even try and put in an offer. We just want to see how you're managing your debt, your credit cards, your store cards, and your loans. And that's how South Africa decides whether to approve your home loan or what, and at which rate, because some people, yes, the credit score is not that bad, but you find that they're getting a bit of a high interest rate because of their habits and how they pay out their debts. So it is easier to get a home loan approved if your credit score is in a good standing, and you get lower interest rates on it, to get rewarded for the fact that you pay, you've got a good history with your payments. And yeah, so everybody can make sure that they pay their accounts on time. They keep their credit usage low. They just use about 30% of their credit card. They don't open too many accounts at once. And they just check their credit score regularly for any errors and report them back, because there is such things like that. And so, yeah, I mean, a credit score opens the doors to better deals, low interest rates, easy approval, and yeah, it is a great thing to actually keep. I know there's so many cash buyers right now in the market, but also those same cash buyers, they're really looking at their scores, and because there's a time where as a homeowner, you need to take up debt when it is in need at that time, and you need to be in a position where you are able to access funds, because cash is key in this environment where maybe you put up your house for rental or what have you, and something happens to your property, and you need that cash flow. So cash flow is king. You need to make sure that although you're a cash buyer in any industry that you're in, your credit score is still good for any emergency.
So the cash buyer, would it be someone that, let's say, you have all the money now, maybe you've won lotto, and then you want to go into that space? Does that categorize you as a cash buyer? And how does that help you if you, let's say, you have the money, you have 1 million, and you're looking for a property let's say is 3 million rand, or let's say it's a 2 million rand, and you maybe need the rest? Can you approach the bank to say that I have a little bit, but the property that I saw would be a property that costs this much, and then they help you as a cash buyer like that? Does it give you so much of a bargaining power when you have this money to say, I have 1 million, that property is 1.2? Does it position you better? Let's talk about that.
It definitely does put you in a bargaining position where the bank can say, okay, this is how much interest rate we're giving you. And you can say, but okay, I come in cash, I've got 50% of the deposit or 60%. That gives you a bargaining deal with the bank, where they can look at the cash you have along with your credit score and give you a better deal. You can make sure that you can get the best interest rate with the cash. It's very much possible with that. And, sometimes when people come in with cash, they forget that credit score still plays a role. A person will say, I've got 1 million, but the house is 1.8. I just need 800,000 rands from the bank. But I already have 1 million. The bank still needs security for the credit score, so that's why it's still important to maintain that healthy credit score. But it really does put you in a position of faster interest rates that you're going to be paying off. And also, if you probably want to keep it as business, then at least you're going to be getting some quick ROI on the investment.
I see. All right, let's leave it here. Vuyelwa, for the morning. I really appreciate you coming through and giving us your time. How do we follow your work? For those that are listening to us, they want to engage with you further, they would like to pick your brain on some of these issues. How do we direct them your way?
So I've got Facebook. It's Real Estate with Vuyelwa. I post houses there, tips there, and that's where people can reach me. That's where you can, let me know if you've got questions or want to know your market value, because that is important. Because another thing, people should not think that upgrading their kitchen upgrades their home. So market value also on the location still plays the role. So yeah, this is where they can be able to reach us and get information. So I'm on Facebook, Real Estate with Vuyelwa. Yes, so yeah, they can contact me there. My phone number is there, my WhatsApp contact, and my work email address, everything is there. And my listings as well, where people would like to see if probably they want to get into the market as new homeowners. They're more than welcome to check out my page.
All right, Vuyelwa, thank you very much for starting the day with us, for giving us your time as well. And yeah, do come back. Let's talk about property some more. But we really appreciate you coming through this morning.
Thank you so much. I'd appreciate. Thank you. I appreciate so much.
Awesome. Vuyelwa Chabalala coming through as a real estate agent and just helping us make sense of some of these ripple effects, the implications of the tariffs on the property market space, but also just helping us talk property 101 and how we can really find ourselves navigating and approaching this one this morning. I want us to break a bit. When we come back, we close the show off with our Tuesday motivation feature.